We all love payday. And when it comes to stocks, the best way to get a consistent payday is dividends. But have you ever wondered, what's better, monthly paying or quarterly paying dividends? Well, that's what we're going to find out in this video. Welcome to the Daily Dough, where we learn finance and investing together. When it comes to investing, a lot of people love dividend stocks because they can give you a consistent form of income, especially when you reinvest those dividends and are able to buy more shares in a company. And over time, dividend reinvestment can compound your gains and really get that dividend snowball rolling. And depending on the company, you can receive those dividends either yearly, quarterly, monthly, and even weekly. But what's the best choice? Can you make the snowball move a little faster by buying monthly paying dividend stocks versus buying quarterly paying ones? Or does it even matter? Well, to help us find out, we can use a dividend calculator, and there are plenty of free ones online. For our example, we are only going to look at quarterly paying and monthly paying dividends. So let's say we bought 10 shares of a company at $100 a share, giving us an initial investment of $1,000. Now the company pays a 5% dividend. And to keep this easy, let's say you never contributed any more money, but rather just reinvested those dividends for 10 years. If the company paid dividends monthly, you would have received $647.01 in dividend payments. If the company paid quarterly, you would have received $643.62 in dividend payments. That's a difference of $3.39. That's not a lot after 10 years. But what if we gave compound interest more time? Would the monthly dividend start to really outperform the quarterly paying one? Well, what if we had the same scenario, but instead of holding for just 10 years, you held for 40 years? In that case, if the company paid dividends monthly, you would have received $6,358.42. And if the company paid quarterly, you would receive $6,298.02. That's only a difference of $60.40. Not really life-changing money. Well, let's be real. Most of us are contributing to our portfolios on a consistent basis. And we invest into the market because we know that if we're invested long enough, our share price will increase. So let's add some of those details and see if we can get different results. With our same example, let's just add that we contribute at least $100 a month or $1,200 a year, and that we average an 8% annual increase. Now, you would receive $525,030.77 in dividends if they were paid out monthly. And your portfolio would have an end balance of $1,395,000 roughly. And if those dividends were paid out quarterly, you would have received $520,307.42. And your end balance would be around $1,386,000. So the difference would be $4,723.35, which may seem a lot higher, but when you divide that by 40, that's only an extra $118 a year. So will a monthly paying dividend stock yield more money? The simple answer is yes. If two stocks performed exactly the same, but one paid monthly and the other paid quarterly, your money would compound faster with the monthly paying one. And there are other pros to owning monthly paying dividend stocks. Not only will your money potentially compound more quickly, but you will receive income every single month. And that regular cash flow to some people can be important. But there are also cons. One con is that there are a lot less monthly paying dividend stocks than there are quarterly paying ones. So the opportunities to invest in really good companies goes down. Monthly dividend stocks also have a reputation of being more volatile than other stocks, which if your share price falls drastically, then it could wipe away a lot of those dividend gains. And when it comes to quarterly paying stocks, you could technically buy a few stocks that pay out in alternating quarters and get a dividend paycheck every single month. The bottom line is, there are some really good monthly paying dividend stocks and really good quarterly paying ones. But the payout frequency shouldn't be why you're investing in a company. But rather, you want to do good research in a company to make sure you understand what you're investing in, to make sure that company can sustain that dividend they're paying, that they have a good management and the company has a resilient business model. So instead of thinking about the frequency, Rather, focus on finding companies that have a strong record of paying dividends and ideally growing those dividends.